Hi, and welcome to our Middle East FitchCast, where we invite our analysts and market participants to give a snapshot of their views on regional debt markets. Today, we will be focusing on infrastructure finance and its development within the region. So within Fitch, the infrastructure finance comes under the umbrella of our Global Infrastructure Group, or GIG for short. So today, we'll be looking at the ratings of some of our issuers, our criteria in its application, and also discuss the trends that we expect will shape 2021 and beyond. So today I'm delighted to be joined by Christiane Kuti. She's a director within our global infrastructure analytics team based out of London, and more recently was appointed as our EMEA Head of Energy within that team. Congrats, Christiane. I'm Ahmed Hassan, a senior director within the business relationship management team based out of Dubai, covering corporates. So before we get into the discussion, I thought it'd be relevant to give you a quick introduction to our overall coverage. Today, our GIG team comprises of 70 analysts globally, providing 700 plus ratings on a public basis. Our coverage is split across sectors such as transportation, energy and industrial, sports and entertainment, utilities, and public and social infrastructure. It's fair to say that most of, probably more than half of our ratings are vested within the transportation and energy sectors. If we actually look specifically at the Middle East within our portfolio, we publicly rate 7 infrastructure entities at the moment, 2 of which were added in the last 12 months. So these issuers are Galaxy Pipeline Assets Bidco, which is the ADNOC pipeline, gas pipeline. We also rate Aqua Power Management Investments, ADCOP, which is the Abu Dhabi crude oil pipeline, DP World, Dolphin Energy, Ras Laffan, and Nakhilat. These have all been issuers within the debt capital markets. If we actually look at the recent trend in the GIG ratings within the Middle East, it's really partly a reflection of the rollout of multi-billion-dollar government-backed investment initiatives that have been met with very favorable project financing conditions, both in debt and in equity for IG names. So with that, let's get right into it and open up the discussion with some points and views on recent issuances which we've been working on within the region. So Christiane, to start things off, it would be great to hear your thoughts on some of the recent transactions which you worked on and some of the sort of relevant key takeaways.
Yeah, thank you, Ahmed. Yeah, as you mentioned already, we've seen an increasing number of project finance issuance from the Middle East over the past few years. We rated the Abu Dhabi crude oil pipeline at the end of 2017. That was really like a pilot project for the Abu Dhabi National Oil Company, short ADNOC, to access funds from international investors on the back of providing access to its oil and gas assets on a minority basis. Since then, we have seen a number of similar transactions. Some are rated publicly, some are rated privately. This similar structure has been used for an oil pipeline portfolio, for related real estate assets. And most recently, at the end of last year, we rated the Galaxy Pipeline Assets Bidco that you mentioned already. Essentially, Galaxy is a lease and lease back transaction that's connected to ADNOC's gas pipeline network in Abu Dhabi, UAE. So if you look at the screen now, I'm showing the structure, which is fairly complex. That's why I think it's good to have a chart here. You can see ADNOC leases the assets to an asset co. Asset co in turn contracts the use and operations of the assets back to ADNOC and receives payments from ADNOC in return. Importantly, ADNOC operates the assets, so we don't have operation risk. The asset co itself is owned by on a majority basis by ADNOC, but also 47.7% by Bidco. That is where the international investors provide equity and debt. So the Bidco raises the debt that we rate to fund its acquisition of asset co, and then ultimately the debt is serviced using the dividends that are upstreamed from asset co. Importantly, the revenue stream that asset co receives to make these dividend payments as well are very transparent and stable, because they are based on the payments from ADNOC ADNOC guarantees a minimum volume commitment and a fixed tariff. So that really removes volume and price risk. And that allows us to rate Galaxy at AA stable, in line with ADNOC's rating. That's based on the strength of the contracts and of course also on the presence of ADNOC as revenue counterparty. Ultimately, we also consider the strategic importance of the assets. The pipeline portfolio represents approximately 95% of Abu Dhabi's developed gas reserves, connecting these reserves. So the pipeline network is integral to the ability of Abu Dhabi to commercialize its gas production, and that clearly incentivizes ADNOC to meet its payments obligation under the contracts with AssetCo as well. I think these projects are particularly interesting, these type of projects that we've mentioned at COP, Galaxy and the other projects, because they really represent part of a restructuring of ADNOC's finance structure. Following the decline of the oil prices, the government of Abu Dhabi implemented a cost-cutting program to really run its hydrocarbon assets on operations more efficiently, and these transactions are part of this drive. They're essentially making efficient use of capital by bringing in international investors.
Yeah, I think you're right. I think it definitely is interesting, and it's, you know, from a structure perspective, it's definitely set a precedent. Do you think that this, now that this precedent is out there, that this has kind of paved the way for other infrastructure credits on the back of these types of issuances?
You're making a good point there, actually. Of course, we don't know if this structure will be replicated elsewhere. There's no reason why it couldn't. There's one point I would note, that the sovereign and sponsor credit quality of Abu Dhabi and ADNOC itself are high. They're in the AA category. Other sovereigns and national oil companies in the region don't necessarily have these same high credit qualities. So investors would need to get comfortable with the legal and political risks in the respective countries, as well as the credit quality, if these countries are looking to adopt a similar structure. But clearly, I mean, this structure could be transferred to other countries, I think, for core oil and gas assets, however. So
do you see? Yeah, do you see it spreading on to other sectors? Potentially, I mean, the diversification of assets into other sectors now. That, I mean, this is the NOCs that we're talking about on the energy side. So, what would be your view on that? Yeah,
I think this structure particularly applies to core oil and gas assets. I mean, the whole contractual setup is involving the national oil companies as revenue counterparties as a stabilizing factor. We can look beyond the oil and gas assets. For example, renewable energy projects. Governments in the region have set very ambitious renewable energy targets. I actually have another slide here that is shown on the screen now. You can see, for example, Saudi Arabia committed to build out 16 gigawatt of wind, 4 gigawatt of solar PV, and 2.7 gigawatt of concentrated solar power capacity by 2030. The UAE is also looking to revise its energy strategy, increasingly focusing on solar energy and also green hydrogen. There were some very competitive solar prices in the latest tenders that we've seen. And that new strategy UAE is implementing is really to be released in 2021 and will support the country's clean energy transition in line with Vision 2021 for more sustainable environment and infrastructure. But that is obviously on the background of very modest renewable energy capacity that's currently installed. In the UAE, I think renewables make up less than 10% of total energy capacity, And in Saudi Arabia, this is still much less. So there will need to be significant renewable generation capacity to be added over the next decade to meet the ambitious targets. Structurally, of course, renewable energy projects are likely to be much less structured in line with the transactions that we've discussed. They are more likely to use typical project finance structuring, so a ring-fenced entity. And the off-taker rating will be important because that typically caps the project rating under our renewable energy and project finance criteria.
Yeah. Just to touch upon the privately funded infrastructure investment, I mean, clearly the double impact of COVID and the low oil price there. I mean, there's the twin shock effect. I mean, where does the privately owned infrastructure investment factor into the wider landscape?
Mm. Yeah, I mean, considering especially 2020 with this twin shock that you described, I mean, the low oil price, the reduced demand, government budgets are now under more pressure, it's clear. That may, on the one hand, curb appetite for investing into large-scale renewable projects. At the same time, of course, renewable capacity is relatively cheap. The auctions that we mentioned, in particular for solar, are turning out record-breaking low bids. So that makes renewables very attractive, really. In particular, as it adds energy capacity in countries that have growing populations, that have already high energy per capita consumption or are even increasing, and ultimately they have very good resource potential. So the solar irradiation, for example, in Saudi Arabia can be twice as high as that of Germany, and Germany is a country that built out 40 gigawatt of solar PV, mostly since the 2000s. So all that really bodes very well for the involvement also of private international investors to support the rollout of renewables. I think one note of caution, I would say, that obviously for this regulatory frameworks are important. In some countries, they are still evolving, and even even where we have legal frameworks, they are not tested. So again, coming back to the country ratings and the political risk, these are also things that the international investors need to get comfortable with. So yeah, I think that there's good potential in the Middle Eastern countries. We need to see what an investor appetite will be. Possibly the picture will be a little bit fragmented throughout the region in terms of the speed of rollout, with countries like the UAE and Saudi Arabia really leading it.
Sure. I mean, one of the kind of overriding themes with most of the ratings that we have in the Middle East is the government-related entity angle of it, so the sovereign-backed nature of it. And it's been, I understand it's been a recent development within our GIG criteria to now have the GRE criteria that overlays our approach when we make these credit assessments. So how is that going to factor in going forward when we distinguish between GREs and non-GREs when we start applying our GIG criteria?
Mm-hmm. Let me start with renewables, as we were already on the subject. So many utility-scale renewable projects in the region are procured from GREs, such as Abu Dhabi Water and Electricity Company, Dubai Electricity and Water Authority, or Qatar General Electricity and Water Corporation as off-takers. And the off-taker rating, as I said already, typically caps the project rating under our criteria. If the off-taker is a GRE, we could assess the rating under our government-related entities criteria, and that could also involve some uplift for the sovereign linkage. In addition, if the government has control over the project itself, such as the main sponsor, for example, we would assess the entire transaction under our GRE criteria, and that could then benefit from more of an uplift. That would depend on our assessment of the strengths of the sovereign linkage and the government incentive to support the project. The rating of the sovereign may therefore be an important factor in the assessment of the credit strengths of these projects.
Yeah. I was going to add on to the GRE examples within NOC space, a strong off-taker. I mean, what are equalizations? The equalizations that happen there, are they also possible too?
Yes. So then we have some examples. You mentioned earlier on our rating on Ras Laffan, liquefied natural gas company. That rating is equalized with the rating of the state of Qatar at AA- stable. And it is rated under the GRE criteria. So Ras Gas's indirect majority holder is the state of Qatar, but it does have control over the project. So the rating also really reflects the status of Ras Gas as an integral part of Qatar's oil and gas industry. And the strong ownership and control links between Ras Gas and the state of Qatar. And ultimately also our expectation that state support would be forthcoming if it was needed. We also deem that the financial implication of a default of Ras Gas for the Qatari state would be very severe. And the socio-political implications are moderate. On a standalone basis, Ras Gas's rating is also strong. We would assess it at A+. So it's not far off, but we can give also that uplift under the GRE criteria, in this case, just one notch. Maybe what's important is really to understand when we deem an entity to be government related. And I've brought another slide with me that is basically an overview of our GRE criteria that you can see now on this screen. So we deem an entity government related when the government, either the national or the regional or at local level, has control over the entity. And that is typically reflected in voting control. And in addition, we will also assess the likelihood of support of that entity in a financial distress scenario. So for example, to avoid negative social political repercussions of a default, if the entity fulfills an important public policy mission, for example. And then we are able to consider the entity as a GRE. And depending on the strengths of the standalone rating and the likelihood of support, the ratings can be equalized or notched up from the standalone credit quality.
Thank you for that. Lastly, then, let's just talk about the triple Ps, PPPs. So how do you see the development of PPPs as a viable source of financing for social projects such as hospitals and schools within the region?
Mm-hmm. Yeah, that's a very good question. Obviously, hospitals, schools, roads, telecommunication systems, they are all common targets for PPPs. But in the GCC region or in Middle East, the power and water sector have so far really dominated the market. With the largest population in the GCC, Saudi Arabia has obviously the biggest potential for these type of projects. And there has been a string of recent developments on housing, education, and healthcare projects. There is the first wave of the National Schools PPP program, which covers the development of about 60 primary schools in Jeddah and Mecca. That's been awarded by the Ministry of Education just last year in September. And we've seen that it reached a financial close as well. That project is part of a 12 billion program, so very large scale. Another potential PPP sector in Saudi Arabia is healthcare. We've seen the Al Ansar Hospital PPP project in Medina that is moving ahead now. It was a little bit delayed during 2020. Similarly, Qatar has launched a schools PPP and healthcare PPP program. And I'm aware of a street lighting project in the UAE at the moment. Some Middle Eastern countries have suffered more in the current climate, of course, with reduced revenues from the hydrocarbon sector, and that can then slow down also the ability to spend on social infrastructure schemes in the near term. On the flip side, during times of increased budgetary pressures, PPPs are appealing to governments because they help to fund projects that would otherwise need to be paid for out of the public funds right now. Of course, a precondition to an active PPP market is the presence of a robust and a transparent regulatory framework. Turkey is a good example here. It's a country that introduced the PPP framework for the healthcare sector, and it took many years to ensure that framework is bankable and was in place ultimately. So typically, social infrastructure projects are structured as availability-based projects. And that means the grantor is often a department of the central government, for example, the Ministry of Health. They are making the payments to cover operating costs and also debt service of the PPP project. The payments are independent of the usage of the assets, and they're purely based on the availability of the assets. So for example, in a hospital environment, it is not important what the occupancy of beds is in the hospital, but really that the assets are available to receive the patients. So that removes price and volume risks, and is therefore quite attractive to investors that look for long-term stable payments, essentially. However, that goes hand in hand, of course, with exposure to counterparty risk, especially the risk of the grantor making its payments. So we have a reliance on the creditworthiness of the procuring authority, and that could ultimately also constrain the ratings.
Excellent. Christiane, thank you ever so much for your insights today. And for those listening, should you have any questions, please feel free to reach out to either myself or Christiane after this session. Again, thanks for listening, and we hope you can join us for our upcoming cast to be published later on during the year. Till then, goodbye.